Hello and welcome to the Women Business Development Center's partnership with the IRS. We're doing a series of 8 workshops over the coming several weeks that we're just thrilled to have Mike Madroncic from the IRS office in Chicago lead us through. Each of these is about an hour. We will be doing Q&A if possible toward the end. So if you have comment or questions, you can just put them in the chat. We may or may not have time for them. I do want to say that the Women's Business Development Center is a nonprofit organization. We're based in downtown Chicago. We actually serve 9 Midwestern states. And we are just thrilled to be able to work with you all and help you in any way that we can. And I am now going to turn it over to Mike and let you take it from here.
Thank you, Karen. And I want to express our appreciation for the opportunity to work with the Women's Business Development Center and all the people that you serve. And we hope that we're going to be able to bring you a lot of great information over the next couple of weeks. So my name is Mike Madroncic, and I do work for the IRS. I work in an organization in IRS that's called Stakeholder Liaison. Our job is to go out and try to create partnerships with organizations that work with small business owners or people who are interested in starting small businesses. We also work with tax professionals and their organizations to try to bring IRS information and resources to those individuals and those organizations. So I am based in downtown Chicago, and I will give you my contact information at the end of the presentation if you would like to get a hold of me if you have questions, or if I can't answer a question today, I can certainly reach out and get that question asked, and I'll provide a response. But today's presentation is one of 8 lessons that we have in what we call a small business tax workshop. Today's presentation kind of is the kickoff, the first presentation in that group of 8, and it's called Federal Taxes in Your New Business. And we are going to be pointing out a lot of information that is available to you on irs.gov. When we make these presentations, and prior to this job that I'm in now, I did work as a revenue agent where I would audit small businesses. So we understand, and I understand through my experience, that as a small business owner, federal taxes are a small portion of your business, but they are very important. And we want to provide you with resources and information to help you understand not only responsibilities, but also opportunities. And those opportunities we'll talk about in the upcoming lessons. Today, let's talk about some basic information, federal taxes in your new business. Whoops, and whoops, sorry. What we're going to do in today's presentation is explain the purpose of an employer identification number. An employer identification number is a number that identifies your business. Now, you may or you may not have to have an employer identification number, and we'll talk about that. We'll describe basic record-keeping requirements for tax purposes, also define some basic bookkeeping and accounting methods, explain the forms of business organizations. A lot of people today work in the gig economy, and we'll explain the gig economy from our perspective. We're talking there about people who drive for Uber, for example. And we'll suggest how you can select a paid tax preparer. I mentioned up front, we understand tax is just a small part of your business that you're running on a daily basis, and so many decisions that you have to make. But we want to provide you with information to help you select a good qualified tax preparer, because we know from experience that a lot of you will use paid professionals to help you. So if you were to go to irs.gov and just looking for information on businesses and federal taxes, I think the best place perhaps to land is this site right here, tax information for businesses. And you can see there in the middle of the screen um, some of the information that's provided and available through this site. We're going to talk about employer identification numbers, that first rectangle. We'll also talk about in a future lesson about employment tax. So if you've got employees, you'll need to understand employment tax responsibilities. If you're a sole proprietor, with a sole proprietor being a person who's just in business for themselves, you're not organized as a corporation. That there's something called estimated tax that we want to make you aware of, and we'll do that in one of the future lessons, where now let me step back. Many of you are coming from a world where you were an employee. And as an employee, your employer withheld federal income tax, Social Security tax, and Medicare tax from your pay and paid it to the IRS. But now, if you're self-employed, you are going to be responsible for making sure that the federal income tax, the Social Security tax, and the Medicare tax that is your liability, your need to make a payment, that you've got to make those payments. And that's what we're referring to when we use the term estimated tax. Your employer will make that payment of the tax on a periodic basis. Withholding it, if you get paid twice a week, they're withholding it, or I'm sorry, twice a month, they're withholding it twice a month. But if you are now responsible for those payments, you've got to make estimated tax payments on at least a quarterly basis. You can also see down at the bottom there, there's information about business types. And we'll be going through that today. So just a good place to get a good resources and information from IRS. Let's talk first about employer identification numbers. This is a number that is issued by the IRS, and it is free to get this number. And everything I'm going to be talking about here today, these are all free resources from the IRS. But an employer identification number identifies the tax returns that you're filing with the IRS. It identifies your business. Now, we'll also find out that in some cases, you may not need to get an employer identification number. That's coming up in just a second. But here, an employer identification number is required if you're paying wages to employees. If you've got a self-employed retirement plan, if you're a partnership or a corporation, if you've organized your business as a corporation or a partnership, if you've got to pay and file returns regarding employment taxes, excise taxes, some employers have to file and pay excise taxes, which are basically taxes on an activity or a like consumption. For example, there's an excise tax on gasoline that is used. That's an example. Banks or other businesses that you work with in your business may require an employer identification number. And you can apply for an employer identification number online at irs.gov/EIN. Again, it's a free resource. This is the website within irs.gov where you can go and get employer identification numbers. If you look at the bottom of the screen, you can see we try to anticipate, and of course, we also received questions many times on the subjects that are pertinent to business owners. So we try to provide that information on the website itself. You can see the first link there, what to do if you're in assigned an employer identification number that you did not request. The second link, do you need an employer identification number? The fourth link, how to apply for an employer identification number. So trying to get the information that you need right there on the site itself. So here is that one site. Do you need an employer identification number? So as you can see on the screenshot, there are questions that you'll need to respond to. And based upon those responses, the site will come back and tell you whether or not you need an employer identification number. So let's go on now to record keeping. One part of the federal tax law does require that filers of income tax returns need to keep the documents that verify their income and the deductions and the credits that they identify on the tax returns that they file with the Internal Revenue Service. So we're talking again, everything here in this presentation is a discussion of the Internal Revenue Service and federal taxes. But the documents that you keep to verify the information on the return, we do have time frames. The minimum is 3 years. And that is because the IRS has a 3-year period of time after you file your return in order to do an audit of that return, unless there's fraud or some other circumstances that we aren't going to go into in today's presentation. If you're filing employment tax returns, you should keep the documentation identifying the information on those returns for 4 years. If you've got business property, for example, you've got a truck that you're using in your business, you should keep the records for that particular asset, in this case, a truck, for the life of the asset, because a lot of times that asset, say you bought the truck for $20,000, the tax law typically, in a lot of cases, tells you that you will take a deduction for the cost of that asset over a period of time, not just in the year that you purchased the vehicle and put that vehicle into service for the business. So you want to keep records during the life of the asset as it's been used in the property, in the business. Now, as I mentioned, we want to point out a lot of resources for you today. The first one here on this page is Publication 583. You can go to irs.gov and go to the link there on the main page for publications and type in the publication 583 in the search box, and it'll bring up this publication, Starting a Business and Keeping Records. You can download it. Again, it's a free publication. You can also go to irs.gov and use the search term record keeping, and it will bring up a lot of great information to help you understand, the type of record keeping that you should be doing in your business. Here is that site, a screenshot of the site. You can tell there are a lot of links to additional information. Why should I keep records? What type of records should I keep? How long I should keep records? The information that we covered in 30 seconds, a lot more detail for you. So let's go on to bookkeeping systems. And probably the simplest method is what we call a single entry system, where you're recording on a daily or a monthly basis a record of the income and the expenses that the business has. For example, my wife has a real estate agent business that I help her with in terms of the record keeping. And we simply identify we use Quicken software, identify the transactions as they come in either identifying them as income or expenses, just a single line item in that software. That single entry system will focus on providing you with a profit and loss statement, how you're doing in the business. And it is sufficient for tax purposes in terms of recording your transactions in, if you're using software or if you're just doing it manually on a piece of paper. That is identification of those transactions, and it is sufficient for putting together the information on your tax return. When I say sufficient, it's sufficient for you to identify, your profit and loss. But in addition to what we're doing here in this single entry system, you need to keep the documentation that supports the numbers in this single entry system. So for example, you bought the truck and you're using it in your business and you bought it for $20,000. It'll be a line item in your profit and loss statement, but you need the documentation that you got from the dealer that identifies what type of vehicle you bought, the price that you paid for it, how you paid for it. All that is needed in order to verify the transactions that are identified in the single entry system. Now, in that second larger bullet point, double entry system, it's more complex. And here you're dealing with accounting, you're dealing with debits and credits. And those debits and credits provide with checks and balances. So for example, if you bought that $20,000 truck, the double entry system would be what we call a debit to the asset account. You've now got a truck that you're showing on your balance sheet, and that would be a debit for $20,000. And cash would be credited for $20,000, showing a decrease in your cash balance if you paid with cash. That's just a simple explanation of this double entry system. So let's go on. Again, resources for you from IRS. This publication 583, Starting a Business, Keeping Records. It's available for free. And now let's talk about accounting methods. We're talking here on this screen about two different methods, the cash method and the accrual method. Under the cash method of accounting, you're reporting income in the year received. So let's say you sold a computer in your business and you sold it for $500, and you received and you sold it in November of the year, and you receive cash from the customer right there and then in November. That income is reported under the cash method in November and for that particular year. You're also under that method deducting expenses in the year that you actually make the payment. Now, under the accrual method, you're reporting income in the year that you earned it. So let's say you sold a computer for $20,000 and I purchased it from you, but I gave you $1,000 in November on the day that I bought it from you. I gave you $1,000, but then I financed the other $19,000. Well, in that particular case, under the accrual method, you, the business owner, would actually report the income in that year that the transaction took place, even though you're not going to get payment of $19,000 until future months and maybe even future years. You're also going to deduct expenses under this method in the year that you incurred them, not necessarily the year that you actually pay them. Let's talk about businesses with inventory. Now, businesses with inventory are typically required under the federal tax law to use the accrual method for sales and purchases. However, there is an exemption for small business owners with gross receipts averaging less than $10 million a year. There, you may use the cash method for sales and purchases. In this publication, 538 provides you with more details regarding what I just spoke of, in the last minute. Here is that publication. Again, it is available for free from irs.gov. So let's take a test. And in this scenario, Sandy's a business owner, and she has a website where she sells custom ordered handmade knitted goods, hats, scarves, and socks. Customers can order these items online. It may take a few weeks or a few months to get the supplies and finish the order. And Sandy doesn't charge until the product ships. She's using the accrual method of accounting and records the sale in the month that it is shipped, not the month that the customer actually makes the order. Is Sandy correct in using the accrual method? That's the question. And the answer is yes. Sandy can use the accrual method of accounting and records revenue when the customer is charged for the transaction. That's just a little example of the accrual method. Let's now talk about business structures. These are ways that you can structure your business. And there are pluses and minuses to each. And it's going to be up to you and your advisors to make a decision. What is the best organization structure for you to use in your business? We'll talk about a sole proprietorship, a partnership, a corporation, which we typically call a C corporation. The C simply refers to a section of the Internal Revenue law that talks about the formation of corporations and the taxation of corporations. S corporation, which is a different type of corporation. Limited liability companies, which are very popular these days. And again, pointing out at the very bottom of the screen, place where you can go and get more information about business structures on irs.gov, irs.gov/smallbiz. Let's start with a sole proprietorship. In a sole proprietorship, the business is not incorporated. So it's not a C corporation, it's not an S corporation, it's not a partnership, it's not a limited liability company. Here, one person owns the business. It's the simplest form of business organization, and the sole owner has complete control. But the owner assumes the risk to the extent of all personal and business assets that they may own and the business owns. So there's a lot of risk. Capital is limited to what the owner can raise, whether it's going out and getting money that you've saved, whether you get money from your relatives or bank loans, however you can raise capital. The sole proprietor will identify the results of their business to the IRS when they file the Form 1040. Now, the Form 1040 is the individual tax return that we all are familiar with when we file individual tax returns to the IRS. But if you've got a sole proprietorship, you're going to include with the Form 1040, and it's part of the Form 1040, what we call a Schedule C and a Schedule SE. SE stands for self-employment tax. I talked a little bit up front about the fact If you're now not an employee and you're a sole proprietor, you are now responsible for withholding and paying to the IRS the income tax, the Social Security tax, and the self-employment tax on the earnings that you have for your Schedule C business. And you're reporting the earnings and those taxes that you have to calculate on the Schedule SE. There's a publication 334 that's available at irs.gov, Tax Guide for Small Business for individuals who use Schedule C, that will provide more information than we can get in here in the short period of time I have with you today. There is a screenshot of, I think, most of the Schedule C, profit or loss from business from a sole proprietorship. So you can see, you identify up at the top your name, the business name. In part one, you're identifying the income from the business, and part two, the expenses. And you come to a net profit or loss down there at the very bottom. There are other schedules that will help you, and instructions in the Schedule C to help you complete this if you're doing it on your own. I mentioned the Schedule SE, self-employment tax. Again, you are now responsible for the self-employment tax, meaning the federal income tax, the Medicare tax, and the Social Security tax that your employer used to withhold from your pay, or may still if you're still a employee but also have a Schedule C business on the side. But that for that Schedule C business, you'll have to calculate the self-employment tax from the operation of that Schedule C business. This is where you're identifying those taxes, calculating them. In addition to the publication that I mentioned regarding sole proprietorships, you can go to irs.gov and type in sole proprietorship in the search box. You can also go to Google and type in IRS sole proprietorships, and it'll probably bring you to that link. But this is a link and a site that talks about sole proprietorships. If you look there in the middle of the screen, it discusses the forms that you would need to file if you're filing a if you're running a sole proprietorship and filing the Schedule C with the IRS. You can see income tax, if you're liable for income tax because of the operation of your business. You would then use Form 1040, the U.S. Individual Income Tax Return, and within that Form 1040, the Schedule C. For self-employment tax, you can see there in the middle, you're going to be using the Form Schedule SE. Estimated tax is really a discussion and a documentation, a determination of the income tax that's associated with your Schedule C. And because you're not, let's say you're not an employee, because you're not an employee and your employer is not withholding tax that it's remitting to the IRS on a periodic basis, you have to make the estimated tax payment that will include the income tax, the Social Security, the Medicare tax, and that is done on a quarterly basis. So what is the difference between the Schedule SE and the 1040 ES? The Schedule SE is just identifying on an annual basis those taxes that I just referred to, those self-employment taxes of the income tax, the Medicare tax, and the Social Security tax. The 1040 ES helps you calculate it on a quarterly basis, those payments that you've got to make on a quarterly basis for those taxes, and determining how much needs to be sent in on a quarterly basis. Now, if you're an employer, those forms noted below, the 941, the 943, the W-2, you'll need to understand those as well. We'll look at those in a future lesson. So let's talk about a partnership. A partnership, you've got individuals who come together as partners, and there's two or more partners in the partnership. And the partners contribute money, property, labor, skills to put the business together and then to operate it. The partners share in the profits and losses. It's easy to organize. There's a definite legal status to the partnership itself. That authority within the partnership, there's a division of that authority that needs to be identified in the partnership agreement. There's liability of the partners is usually unlimited. So in this respect, it's a lot like the sole proprietorship. For the IRS, a partnership will file a Form 1065, and I'm sorry it's not identified there. I think we're going to show you a screenshot in just a second. But the Form 1065 is the income tax return of the partnership. And each partner gets a Form 1065 Schedule K1. A Schedule K1 with a partnership, the net income or loss flows through from the partnership to the partners. And that income or loss is identified on the Schedule K1. And the partners will use the Schedule K1 to then identify that income or loss from the partnership on their individual income tax return. Now there's a publication 541 from IRS titled Partnerships, and there it is. And it will provide you with much more detail than I can provide here in the minute that I have that we discuss partnerships. Remember, we're going to, if this seems a little bit overwhelming, we're going to identify resources for you. If you're going to go to help and get help from a tax professional, we'll also show you resources to help you with that. So publication 541 is available for you, and it's free from irs.gov. Also on irs.gov is much more information on partnerships. You can see all the links there, forming a partnership, making partnership distributions, understanding some rules, and even a link if you need to end the partnership. So a lot of great information to help you if you're in those specific situations. Let's talk now about a corporation. And a corporation is a legal entity that is separate from its owners. So as we'll see in just a second here, it provides more protection for you. That legal entity has rights and duties of its own, meaning the corporation. The owners of the corporation are stockholders/shareholders, and those stockholders have a limited liability. One thing that's easy about the corporation is that the transfer of the ownership is easy. The stock is typically easy to sell. There's advantages for the corporation in terms of raising capital and expanding. It may be easier if you're in the corporate form. This corporation that I'm referring to, the C corporation, again, C is from the federal tax code. It is subject to tax on income at the corporate level. So if you set up a C corporation, that corporation is going to be taxed. And then any income that you receive from the corporation is also subject to taxation to you at the individual income tax level. So a double taxation. And it's one reason why some individuals choose not to incorporate as a C corporation. Every individual situation is different. So you've got to discuss this and understand what is good and what is best for you in your own specific situation. As I mentioned, the dividend income, the dividend that the corporation will pay to you as the opener is taxed to you at the shareholder level. A corporation, the C corporation, files with the IRS a Form 1120, which is its income tax return. And if you're looking for information from IRS in regards to corporations, we have the publication 542, which is what you see here. This is a screenshot. A lot of great information, as you can see from the contents there. If you're looking for information on irs.gov, we have information on on forming a corporation here at this site. And as I showed you for a Schedule C, we also have information on this is from irs.gov. And if you were to form a C corporation and you were looking to understand the types of forms that you need to file with the IRS, this site within irs.gov will provide that information to you. You can see there income tax for a C corporation that has reporting the results of operation to the IRS. It's reporting its income tax return on that Form 1120, as noted in there in the middle. Now, if you are a corporation, a C corporation with employees, you've got employment tax responsibilities, and that's identified there in the middle section. And you can see the forms that you'll have to file with the IRS if you've got employees. And again, we will discuss those in one of the future workshops. S corporations have also been a very popular way to organize business over the last 10, 20 years. Here in an S corporation, shareholders elect to have S corporation profits or losses taxed like a partnership. So I mentioned with the C corp, the income is taxed at the corporate level, but then any dividend and income that you receive from the C corporation, you're also, as the shareholder, getting taxed on your individual income tax return. The S corp was set up so that, like a partnership, the income or loss from the S corporation flows through to you as the S corporation owner. So that double taxation that we talked about with the C corporation, is not coming into effect here with an S corporation. That's one reason why it's a popular choice. And when you are organized as an S corporation, you actually you file a Form 2553 to identify that. And the S corporation, as I've mentioned, does not pay tax on income from daily operation. Income losses, deductions, and credits pass through to you as the shareholder. There's no double taxation. The shareholders will report the income they receive from the S corporation on their personal tax returns, their Form 1040. But the corporation itself does file a Form 1120S, which is an income tax return, but it's typically just an information return that's being filed with the IRS. There are some situations where the S corporation will get taxed, but those are unique situations. Just like with the partnership, each shareholder in a S corporation will get from the S corporation the Form 1120S each year, Schedule K1, and it identifies the profit, the income, the loss, the deductions, and the credits that specific shareholder is receiving from the S corporation. And that information is used to report the income or loss on the individual shareholders, S corporation shareholders' individual income tax return. So if you're looking for information about S corporations from the IRS, This website within irs.gov will provide information to you. You can see on the right-hand side of the screen, we provide a lot of information related to S Corporation, links that will take you to more detail than we have time available here today. Just like with the C Corporation and the sole proprietorship, if you're looking to understand the filing requirements that the S Corporation has with the Internal Revenue Service, you can come to this site within irs.gov and you can see if you are an S corporation and you need to file the income tax return, you're going to file the form 1120S there in the middle. There also, as with everything, there are instructions to help you file that form 1120S. If you're a S corporation that has employees, you're going to have employment tax responsibilities, and that's what the second row there is identifying. You will need to file those returns that are listed, and again, we'll get to those in a future lesson. For S corporation shareholders, again, you're receiving information from the S corporation that you'll need to report on your form 1040. That's that first row. And again, you may have estimated tax responsibilities where you've got to make payments for the Medicare, the Social Security, and the income tax on the income that you're receiving from the S corporation. That's the second item that is listed there, estimated tax. Okay. Over the last few years, a limited liability company has been a very popular form of organization for business owners, and it's a legal entity created under state law. The owners are referred to as members, and members can have limited personal liability. Like a partnership, the LLC provides management flexibility and this flow through taxation that we've been talking about, where the income or losses from the limited liability company are flowing through to the members, and those members are reporting those numbers on their individual income tax return. Now, if you've organized your business as a limited liability company, per the IRS federal tax law, you can treat the LLC as either a sole proprietorship, a partnership, or a corporation. And you've got to make that identification to the IRS by filing the form 8832, Entity Classification Election. If you're looking for information on a limited liability company and the information that you need to try to understand what an LLC is and how it may or may not suit your individual purposes, IRS does have this site within irs.gov, limited liability company. And it'll bring out more information regarding if you do choose an LLC, what you need to do regards to filing with the IRS. We do identify another good resource that's available to you, and that's from the U.S. Small Business Administration. Choosing a business structure where there's a lot of good content talking about the different structures that we went through here today and giving you information to help you make a decision as to what type of organization you want your business to adopt. Now, as we mentioned at IRS over the last several years, we've seen a lot of individuals who are become part of the gig economy. Gig economy, the example I use, someone who's driving for Uber, they are part of the gig economy. They're out working, doing what they're doing, and receiving information from, in this case, our scenario, Uber, that identifies how much income they've earned driving that vehicle during the year. We want everyone to understand that gig economy income is taxable, and you've got to be reporting it on your federal income tax return. So there is information at irs.gov/gig to help you understand responsibilities and opportunities as someone who works in the gig economy regards to federal taxes. We have a gig economy tax center that I just showed you the link to. Here it is, a screenshot discussion about what is the gig economy, identifying that income that you earn from the gig economy is taxable, and information down there at the bottom for gig workers, how to manage taxes for your gig work. We want to provide you with resources to help you understand your responsibilities. You work hard, you put your business together. We want you to make sure that you're doing everything that you can and have an understanding of what you need to do to file your returns and pay your taxes, your federal taxes. So as I mentioned, here's some of the information that's going to be available for you through those resources. And as I've been mentioning during the discussion here today, we understand that you as small business owners, you've got a lot on your plate. This is just a part of your business, but we want you to be able to have the resources to make good decisions, to find people who can help you. And we understand that a lot of people do get help. Tax preparers who help you prepare the returns that I've discussed here today. Payroll providers to help you prepare the employment tax returns and make the employment tax payments to the IRS that you're responsible for if you've got employees. One thing you should understand is that there is no federal law that requires a individual who starts a tax preparation business to have a certain amount of education or to pass a certain test. Anyone can open up a tax return preparation business. There are a couple of states that do have laws regarding the regulation of tax return preparers. But on a national level, that does not exist. So we want to provide you with these tips. We want you to avoid preparers who will make claims to you that they can get you larger refunds. Avoid preparers who base fees on refund amounts. Avoid preparers who won't sign the return or won't give you a copy of the return. Always make sure that the return that's been prepared for you, you look at and agree with the numbers that are on that return, and make sure that the individual who's preparing the return is going to sign that return. They, as a paid preparer, need to sign the return. Don't ever sign a blank return, and always review it before you sign it. Make sure that your preparer is going to be available to you, not just during the tax preparation season, January through April 15th usually, but then afterwards as well. Make sure that the paid preparer has a valid IRS preparer tax identification number. That is one requirement that the IRS has in place. If you are a preparer who gets paid for preparing tax returns, you have to register with the IRS and on an annual basis get or renew this preparer tax identification number. Ask for the PTIN number of the paid preparer. You can go to irs.gov and use the search term choosing a preparer. If you go to irs.gov, you can also use the search term need someone to prepare your tax return, and it will give you this site, which provides a lot of great information to help you make that important decision. Let's talk about paid preparers. And I did mention that there is no federal law in place that requires an individual to have a certain certification or pass a certain test in order to start a tax preparation business. Again, there are some states that do have laws, but there are certifications that an individual can obtain, and that's what we're identifying here on this screen. An enrolled agent is someone who has passed a test that is given by the Internal Revenue Service, and it allows them to uh, provide their clients with unlimited representation rights before the Internal Revenue Service, and they've passed the test given by the IRS. CPAs, certified public accountants, and attorneys. CPAs do pass a test that is given by their state licensing agency. And part of that test does have a requirement to understand information about tax law and pass the section on tax law. And they also have continuing education requirements, as do enrolled agents. They have to have a certain amount of continuing education each year. Attorneys, there are some attorneys who focus on tax law and of course have to pass the bar exam and are registered with their state registration agencies. There's also a annual filing season program that the IRS operates, and here individuals who are not enrolled agents or CPAs or attorneys have an opportunity to earn this designation from the IRS. They're passing an annual test that is on federal tax law, IRS procedures, and it gives them limited representation rights. And when I say representation, let's say you file your tax return and the IRS chooses to examine it. These individuals can represent you in front of the IRS if they've passed this annual filing season program they have limited representation rights. The enrolled agents have unlimited representation rights, as well as the CPAs and the attorneys. Now, the PTIN holders who are just getting that PTIN number from the IRS and don't have these designations that are listed above the PTIN holder, they do not have any authority to represent you before the IRS. Now, there is a directory that I will show you in just a second of federal tax return preparers with credentials and select qualifications that's available through the IRS that identifies individuals who have these credentials that we've been talking about. Here is the site. It's called, if you search for Directory of Federal Tax Return Preparers, you can come to this site, and as you can see down at the bottom, there you can type in your zip code and you can come up with a list of the individuals who are registered within this site, and they have credentials and select qualifications that we've been talking about and can help you, again, within your neighborhood, help you with any federal tax or probably state tax probably questions as well. So this is a resource that we want you to be aware of. And with that, I've come to the conclusion of this presentation. I want to thank everyone for being here today. We really, really appreciate the opportunity to come before you and provide you with this. And with that, I'm going to turn it back over to Karen and close things out.
Thank you, Mike, so much. Really appreciate all of this great information. A couple of questions, and Mike, one of the questions was about international clients. Does it matter if you have an LLC and you have revenue coming in from overseas? Does that impact how you as a US-based LLC would, have responsibilities?
No, I don't want off the top of my head give you an answer. If you don't mind, I'd rather go back and research that for you
Thank
and
you.
get a specific answer. I don't have experience with the international tax side of things, and I feel more comfortable doing some research and getting that information to you.
Thanks so much. And so the person who asked that question can send me that in an email, and I'm going to just put my information right there, and you can just shoot me the email and I'll make sure Mike gets it, or you could send it to Mike directly. The only other question I think that wasn't answered is that form 8832 to select the type of payment status. Is there a timing for that? When do you have to submit that in order for it to be effective?
Uh, yes, there is timing, and again, not off the top of my head, I'd rather get specific information for you, which will be in the 8832 instructions. Um, so that information is available. Off the top of my head, I don't remember it, and I don't want to give you bad information. I'm sorry.
Oh, that's okay, Mike. Thank you very much. Yeah, and that's a good point that there is a lot of excellent information if you actually read the instructions in those forms. So that would be another thing to do. I want to thank everybody for coming. Tomorrow and then next week and the next week and the week after that, maybe the week after Thanksgiving. Anyway, we have the additional lessons that Mike referenced. Tomorrow's is going to be about Schedule C and other small business taxes to think about. So kind of a little bit of a deeper dive into what Mike kind of referenced today, specifically like qualified business income deduction and so forth. If you go to our website, the events calendar, which I just put in the chat, you can register for it. We did have to set it up so that every single one of these is its own registration. That's because of my lack of ability of dealing with Zoom. So you could just go ahead and register. It is not the same Zoom link. And once all of this is done, all of these sessions are done, we're going to have these on our website, but probably not until that. So I want to thank all of you for spending your lunch hour today with us, and especially Mike for all of this great information. And we will see you tomorrow. Thanks so much.
Thank you.
Bye-bye.